You know, for decades, we've talked about the U.S. national debt as an economic problem, right? Something for accountants and politicians to hash out. But what if the whole game has changed? What if the numbers have gotten so huge they've turned into a real, honest-to-God threat to national security?
So let's just dive right into that. The big idea we're exploring here is that the national debt isn't just a line on a spreadsheet anymore. It's become a critical vulnerability, one that could actually dictate whether America can even defend itself and its interests on the world stage. And this is the number that's setting off all the alarm bells. Projections are showing that the national debt could hit a staggering $56 trillion by 2036. I mean, it's a figure so big, it's almost impossible to wrap your head around. But what it means, well, that's becoming terrifyingly clear.
And look, this isn't some fringe theory from the internet. This is a direct warning from the Bipartisan Policy Center. They're worried that the government is going to be so busy just trying to manage its debt that our own national security will have to take a back seat. And that's the exact moment an economic issue officially becomes a security crisis.
Okay, so here's how we're going to break this whole thing down. First, we'll look at the security crisis itself, then get into how this giant debt machine actually works. We're going to cover the real trigger, the interest payments, and a pretty serious warning from history. Then we'll see why there's no easy fix and what it all means for the future.
All right, let's start with the heart of the problem, the security crisis. The key takeaway here is this. When a country's financial choices are dictated by what it borrowed in the past instead of what it needs for the future, its power and influence in the world just, well, they start to evaporate.
But to really get why this is a crisis, you gotta understand the machine that's creating it. And honestly, it's a surprisingly simple but just relentless cycle of deficit spending. Let's walk through how it all adds up.
So, think of it like your household budget, just on a massive scale. The government collects about $5 trillion in taxes, but it spends around $7 trillion. That $2 trillion gap, that's the annual deficit, and they have to borrow it. Every single year, that new borrowing just gets tacked onto the total national debt.
So who's lending all this money? Well, it's a mix. A whole lot comes from right here at home. Domestic investors, big banks. But a pretty big chunk comes from other countries like Japan, the UK, and yes, China. And if they can't borrow enough from all those sources, the government turns to its lender of last resort, the Federal Reserve, which, let's be honest, essentially prints the money.
Now, for years, this system just kind of chugged along, mostly because borrowing money was super cheap. But, and this is a huge but, that has all changed, dramatically. Which brings us to the real catalyst, the thing that's turning this problem into a full-blown crisis right now, the absolutely skyrocketing cost of interest on the debt.
And what's just wild here is the sheer speed of this change. Back in 2020, the annual interest payments were about $345 billion. By 2025, they're projected to hit nearly $1 trillion. This explosion happened because the Federal Reserve jacked up interest rates to fight inflation, and that made all that government debt suddenly way, way more expensive.
And this slide right here perfectly illustrates that crazy shift in priorities we talked about. For the longest time, the nation's number 2 expense, right after Social Security, was national defense. Not anymore. Now, it's interest on the debt. More of your tax dollars are going to pay for stuff we bought yesterday than for our military today. Think about that for a second.
We are getting dangerously close to the point where the government will have to borrow new money just to make the interest payments on its old debt. It's the classic debt spiral, like using one credit card to pay off another one. It is, by definition, totally unsustainable.
You know, this might feel like a uniquely modern problem, but it's really not. So let's zoom out for a minute because there's a historical theory that describes exactly what happens when a great power gets caught in this kind of trap. It's called the Ferguson Limit. And the core idea is, well, it's simple, and honestly, it's pretty chilling. The theory says that the moment a nation's spending on interest payments overtakes its spending on defense, its decline as a major power begins. It's a historical tipping point. And we've seen this movie before. The once mighty Ottoman Empire got crippled by massive debts to foreign powers. As those interest payments just ate up its budget, its ability to project power and hold its empire together just crumbled.
Or, for a more recent example, look at Great Britain after World War I. The unbelievable war debt they racked up meant paying that interest became a top national expense. That financial strain was a huge factor in speeding up the decline of the British Empire. History is basically screaming at us right now.
So right about now, you're probably thinking, okay, this is obviously a disaster. Why on earth doesn't the government just, fix it? Well, the answer is a nasty political trap where every single solution comes with immediate and pretty severe pain.
When you boil it all down, there are really only 2 levers you can pull. You either slash government spending in a major way, or you raise taxes a lot. The problem is, in the short term, both of those options are politically radioactive because they hurt the economy.
I mean, if the government cuts spending, businesses lose contracts, people lose jobs, and you likely trigger a recession. If they raise taxes, it can crush investment and slow the economy down, not to mention the massive political backlash. No politician wants to be the one to cause that kind of pain. So, what happens? The can just gets kicked further down the road.
And this brings us right to where we are today. A future on really shaky ground. Because this isn't some far-off theoretical problem for our grandkids anymore. We are already seeing the real-world consequences as global confidence in the U.S. financial system starts to wobble.
Just look at the credit rating agencies. These are the independent referees that grade a country's ability to pay its bills. S&P downgraded the U.S. way back in 2011. Fitch followed suit in 2023. And with analysts watching Moody's very closely, the pattern is undeniable. This isn't a fluke, it's a trend, and it's picking up speed.
And of course, the markets are reacting. We're seeing major foreign debt holders like China slowly selling off their U.S. bonds. We're seeing more volatility in the stock market, a growing interest in safe haven assets like gold, and more investors are starting to look for growth in other countries. These are all flashing warning signs.
So, that leaves us with the final critical question. The U.S. has hit a point where paying for the past is eating up the money we need to build the future, whether that's in defense, technology, or infrastructure. History has shown us what happens when empires reach this point, and none of it's pretty. The only real question left is, what happens next?